today we will be discussing about the last two elements of financial statements, the income and expenses, in one video. This will complete the detailed discussion of all the 5 elements of financial statements before we discuss the double entry accounting system in the subsequent weeks. But before we go through all of that, I would like to welcome you all again to Accounting Zero to Hero. We are here to help you understand the fundamental accounting concepts through simplified technical discussions and practical applications of the accounting standards. All of this to help you go from zero to hero. Now let's go back to the video. As with all other elements, income and expenses are covered in Chapter 4 of the conceptual framework. So previously, we have discussed the assets, liabilities, and equity. The links to the discussions are in the description below. Now we will cover the 4th and the 5th elements of financial statements, which pertain to the changes in resources and claims, reflecting the entity's financial performance. This part right here is very important in understanding the nature of income and expenses. What we are saying here is that income and expenses are changes in resources, which mean that changes in assets and changes in claims, other than those pertaining to the owners of the business, which means that the conceptual framework means changes in liabilities. In short, income and expenses are simply changes in assets and liabilities other than those pertaining to the owners of the business. That's why we are saying that these are relating to the financial performance of a business. I want you to remember this definition because we will revisit this later when we discuss how it all fits in the accounting equation of assets is equal to liabilities plus equity. Income and expenses are the elements of financial statements that relate to an entity's financial performance. The first 3 elements above that we have discussed before relate to the entity's financial position. Users of financial statements need information about both the entity's financial position and financial performance. Hence, although income and expenses are defined in terms of changes in assets and liabilities only, information about these two is just as important as information about the assets, liabilities, and equity. Now let's go to the more specific definition of income. The conceptual framework says that income is increases in assets or decreases in liabilities that result in increases in equity. So this part is important, other than those relating to contributions from holders of equity claims. So it means that if there is a transaction with the owners of the company, if the owner of the company contributed money to the business, or we distributed money to the owners, they do not form part of income and expenses because these are equity transactions. So if we are going to visualize the definition of the conceptual framework, income represents the following movements: increases in assets, decreases in liabilities. To be honest, I like to think that both income and assets are sort of the good elements of financial statements because obviously, if you own a business, you will generally want to own more resources and you want to generate more income. So they move in the same way. An increase in asset is equal to an increase in income, and in the same way, a decrease in liability is equal to an increase in income. For the second part, a common idea is that, for example, if your creditor comes to you and says that they do not anymore want to demand payment of the liability, it means that you have to decrease your liability because it is going to be extinguished. However, since you did not give money to the creditor, it becomes an increase in income. Common examples of income are, number one, we have sales, whether cash or credit. So they are income, whether you receive money or not, because if you receive money, you increase your cash. If you did not receive money, you increase your receivables, which are both assets. Another example of income are interest income. Interest income are the money we generate from our bank accounts or investments. Expenses, on the other hand, are decreases in assets or increases in liabilities that result in decreases in equity, other than those relating to distributions to holders of equity claims. Just like the income example that we gave in the previous slide, I like to think that expenses are sort of the bad elements of the financial statements, in a way that they actually have a inverse relationship with your assets. That's why we're saying that expenses are decreases in assets or increases in liabilities. The inverse relationship means that this decrease in asset means that expenses increased. And increase in liability mean that expenses increases as you increase your liability. Common examples of expenses are the payments to suppliers. So when we pay for services like repairs, rent to the landlord, so they are actually expenses because you decrease your asset to pay, which results to an increase in expenses. For example, we have rent. Another type of expenses are the interest expenses we pay to financial institutions whenever we borrow money from the bank. We will revisit this more practically when we discuss the double entry system and the concept of debits and credits. But for now, I would like you to first understand the relationship of the expenses and income with your assets and liabilities in terms of just increases or decreases. So now you know that there are actually 5 elements of financial statements. But out of the 5 elements, you will see that only 3 are actually being used in the accounting equation, which is assets is equal to liabilities plus equity. So where do the income and expenses fit into the accounting equation? In fact, we do not actually have to extend the accounting equation to fit the last 2 elements that we discussed, because they are just defined as movements in assets and liabilities. So to recap, income is increases in assets, like here, or decreases in liabilities, you can see here, that result in increases in equity. So if you can see the equity side here, they're actually both increases. These are movements relating to the financial performance, which means that they exclude any transactions with owners. So as you can see, if you fit the definition of income as per the conceptual framework right here into the accounting equation, they result to movements in assets and liabilities that both increase equity while maintaining the balance of the accounting equation. So income increases equity in general. So if you think about it, to balance the accounting equation to increase equity, you have to either increase your assets or decrease your liability. That's one way of looking at it. The reverse analysis is also applicable for expenses. Again, Expenses are decreases in assets or increases in liabilities. So decreases in asset and increases in liabilities that result to both decreases in equity. So when you think about it, expenses actually decrease equity. Always. So, in order to balance the accounting equation, decreases in equity should be partnered with decreases in assets or increases in liability, excluding transactions with equity owners. To cap off the discussion, I would like to discuss the income and expenses of Apple Incorporated so that we can see how it is actually presented in the financial statements. What you see in the screen are the statements of financial performance of Apple for 2019. The statement of financial performance mean that we will see income and expenses, as we have discussed before. Because when we say statement of financial position, we mean the balance sheet or the assets, liabilities, and equity. So we can split the statement of financial performance or the statement of operations into three parts. The top part are the income, normally from operations. This part right here are the expenses. And then I can identify some others pertaining to other income or the provision for income taxes. As you can see, once you add all the income, expenses, and the other movements, you will find that Apple had a net income of $55 billion during September 2019. The $55 billion net income of Apple can be split into income, expenses, and others. The income are mainly coming from the sales of products and services. I think the products are mainly of iPhones, MacBooks, etc. And services, whenever you have services in their service centers, it will go to the income from their services. It means that they earned a total of $260 billion from sales of products and services during the year. This part right here, the cost of sales, means that out of the $260 billion, the cost of the iPhones to manufacture them, all in all, is $144 billion. And the cost of the services, directly related to the services that is being rendered to the customers, are $16 billion. Other expenses of Apple include research and development and general administrative expenses and selling expenses. These are normally separated because they are not directly related to the products and services, but they are necessary in the operations of the business to produce the iPhones or to produce the products or services that Apple is offering. Lastly, all the other income and expenses are in this line item, and we also have to deduct the income taxes to come up with the net income during the year of $55 billion. In summary, income and expenses relate to the financial performance of the company. Generally, income are increases in assets and decreases in liability. And expenses are decreases in assets and increases in liability. Also remember that income and expenses do not include transactions with equity holders or the owners of the business. So this is it for now. I hope you learned something from the discussion. For the next video, we will start discussing the double entry accounting system. Don't forget to subscribe and hit the notification bell, and see you